Hello and welcome to another episode of Sustainable Conversations. My name is Olivia Hart and I'm the Senior Researcher for our Global Green Guide. I'm joined here this morning by Weilin, who heads up Rajah Tann Sustainability Practice, in addition to being partner in the Banking and Finance Practice Group. And today we'll be discussing sustainable finance developments in the ASEAN region. Weilin and the team of award-winning sustainability practice group specialist lawyers work together to provide legal solutions on sustainability-related matters across industry areas and sectors. And this includes working on green financing projects, conducting ESG due diligence, and advising on the creation of carbon credits, just to name a few things. Weilin is also an IFAS certified ESG analyst. So thanks so much for joining me today. I'm really looking forward to this conversation. I'll just dive straight into the first question. What are the recent sustainable financing trends in the ASEAN region?
Thank you, Olivia, and hi everyone, I'm Weilin. So what are the recent sustainable financing trends in the ASEAN region? Let's start with where I am now in Singapore. Green and sustainable financing has been on the rise because there is a development in corporate direction on the importance of ESG for businesses. And a poll that was done in Singapore shows that 94% of the Singapore companies actually think there are multiple opportunities for their business from improving the environmental and ethical sustainability and points. And these companies also believe that a greater focus on sustainability will drive growth. Some of them even expect, I think up to 48% actually expect a modest growth of up to 5%, 26% expects growth of between 6 to 9%. So quite a bit of expectation over there. Now, in Singapore, the main focus on such financing relates to decarbonization and environmental considerations. The Monetary Authority of Singapore, which is our central bank, has cited that some $200 billion per year of green investment is estimated to be in ASEAN through 2030. And in terms of the policy landscape, in order to support and facilitate Asia's transition to low carbon economy, the Monetary Authority of Singapore has issued guidelines on environmental risk management to guide financial institutions to manage, mitigate, and disclose climate change and other environmental risks. And to develop the green financing market, there is in place the sustainable bond and green and sustainability linked grant schemes to defray cost of all of these instruments, issuing of instruments and loans, and to promote sustainable lending frameworks that provide simplified processes and standardized criteria for borrowers. And there is also in place in Singapore an insurance-linked securities grant scheme to defray the cost of catastrophe bonds issuance. So that's what's happening in Singapore. How about the rest of the Southeast Asian region? Now, a publication by World Bank in November 2022 actually showed that, well, some of the ASEAN countries, in comparison to other developing economies in the region, have made greater efforts in recent years to develop the sustainable financial market. There are economies here that where the sustainable financial market remains rather limited. Now, in the World Bank research that was done, they looked at 5 ASEAN economies: Indonesia, Malaysia, Philippines, Thailand, and Vietnam. And actually, only 83 corporations in these 5 ASEAN economies have obtained financing via sustainable financial instruments since 2017. And the report goes on to say that sustainable debt markets have financed mostly only listed firms with investment grade, whereas private equity markets have funded small corporations with projects in climate and clean technologies. There are some limited range of sustainable financial products and offering of financial institutions in the ASEAN 5 countries, but insurance, on the other hand, is notably absent. So what we can see from the sustainable financing trends and landscape over here is that there is a lot more potential for sustainable financing in the Southeast Asian countries. And I think there should be even more urgent need to do so, particularly with 2030 coming up. you may know that in 2030, or rather in the United Nations member state in September 2015, they have signed up for the 2030 Agenda for Sustainable Development, where there were the 17 UN SDGs set. And we are now less than a decade away from delivering these goals, and a lot more of sustainable finance would have to be in place in order to achieve these SDGs. UN report had actually stated, because of the historic underfunding and whatever that has happening due to the high inflation that spiked from the Russian war and Ukraine, we have required even more costs in order to achieve the SDGs. So in the region, we see a lot of these economies with a lot more potential in sustainable financing.
And why is sustainable financing important to address climate change and sustainable development challenges in the region?
So, well, in the region, climate change mitigation and adaptation efforts are urgently needed. This is the region where some of the most greenhouse gas intensive economies in the world are. And at the same time, climate change is significantly impacting the total operating environment for firms, for investors, and for communities. And economies in Southeast Asia are one of the most exposed in the world. So climate change related disaster cause significant economic and social loss, and it poses severe risk to Southeast Asia's long-term economic development agenda. Now, what is then sustainable finance? Harvard Business School defines sustainable finance as investment decisions that take into account ESG factors as of an economic activity or project. And why is it so important to influence climate change and sustainable development? Well, it's important for various reasons, one of which is because from a systemic perspective, long-term institutional investors can help rebalance and redistribute climate-related risk and maintain financial stability by making investments in companies which business are low on climate pollution, or by demanding that their portfolio companies take necessary action to reduce carbon emissions. So there are, for example, financial instruments like hedging instruments, or catastrophe bonds and index insurance, and these help to insure against increasing natural disaster risk. And there are other financial instruments of green bonds and green stock indices, for example, to help reallocate investments to green sectors. Then from a regulatory oversight perspective, central banks and other regulators can adapt frameworks and practices to address multifaceted risks posed by climate change. And this would then improve, these regulations are aimed at improving climate risk disclosure and classification standards. And all of these help financial institutions and investors better assess their climate-related exposure, and generally to gauge the system-wide risk. So in sustainable financing, there is an underlying presumption that the private sector, together with the public sector, will play a role in redefining what is business as usual. And in this redefinition of what is business as usual, that can bring about transformational changes, which is much needed to address climate change and sustainable development in the region.
And what are some of the challenges faced by the market, and what can really be done to scale up on sustainable finance?
I think this question, everybody kind of know the answer, which is data, the availability of actionable ESG data. And in the region particularly, financial institutions have found it very costly to factor and to process these climate-related information, if at all available. And in addition to the complexity of the sustainability matrix and the lack of reporting standards. Now, the lack of standardization and the lack of disclosure have resulted in uneven and inconsistent disclosure. And a 2020 Milken Institute report that compared 2018 ESG scores from 3 major rating agencies found varying ESG scores for most assessed companies, except for the worst performing one when it comes to ESG standards. So that's something that's troubling, because there can be varying ESG score for a single company depending on the type of rating matrix that you use. The lack of common language on what is green means that there's no consensus on what would allow players to understand the ecosystem. The stakeholders, consumers, investors, regulators, companies, they need to know that they're all talking about the same thing. They must be talking in the same language and working towards the same environmental objective. But if there is no common language, there is the fear of greenwashing. In Singapore, in order to improve the reliability, the consistency, and the comparability of all of these information, sustainability disclosed information, I think the central bank have supported TCFD's recommendation and the to be developed ISSB standards. The Singapore Exchange has set out a roadmap for mandatory TCFD disclosure by listed companies. The Central Bank Monetary Authority of Singapore introduced disclosure and reporting standards, reporting guidelines for retail ESG funds, and they will consult with financial institutions on mandatory disclosure requirements based on ISB standards. And Singapore is also looking at developing a taxonomy for green and transition activities so that we can better classify these activities to unlock sustainable finance flows and to mitigate greenwashing. That's one challenge. And I think a second challenge is, well, how do we support today's carbon-intensive business transition? How fast should investors or stakeholders demand companies to decarbonize? And how do you differentiate what is considered to be an ambitious but sincere transformation? And would it be gradual? Because business as usual for most companies would be a gradual corporate transformation, but gradual may not be enough. And then again, the point of greenwashing, would a company saying that they are transiting will not have transited in the next past 5 years mean that they're greenwashing? And so there are many questions and many challenges. Well, it may not be a complete solution, but definitely it requires the public sector and the private sector to work together and in parallel. There needs to be public policies in place to bridge those critical data gaps, to develop robust frameworks for measurement, reporting, verification, developing of taxonomies. And private investors, they need to work together to undertake what would be considered to be a forward-looking assessment of corporate climate strategy. So together, this moves the market, and perhaps there needs to be capacity building as well amongst the investors. There needs, especially in the region, there must be a better in-depth understanding on what the frameworks are and what is a suitable metrics for a particular sector, for a particular economy, a particular jurisdiction. And only by understanding the sector, the business of these companies, would then there be, well, development towards something that's streamlined, towards something that everyone, all the stakeholders can agree on what is considered to be a timeline for corporate transformation. And perhaps there has been already some global developments on this, such as the High-Level Advisory Board on Effective Multilateralism, a whole mouthful. They look at exploring reforms for global financial architecture that will help channel more public and private funding to issues that relate to global commons. Yeah, so that's basically, well, I would just briefly say 2 key challenges faced by the market at this point in time.
So it's said that to reach net zero goals, green finance is not quite enough, and what is really needed is transition finance. What is transition finance, and why is this the case?
well, before we go into transition finance, maybe we have to look at what exactly is green financing. So green financing means financing something that's already green activities. So the focus would be largely to support activities that involve minimum pollution and carbon emission. However, what is really needed is financing that is directed at the carbon intensive sector to help them decarbonize and in that way to achieve net zero. Transition finance is therefore that concept of where financial services are provided to high carbon emitting industries, such as coal-fired power generation, steel industry, aviation construction, and to fund the transition to decarbonize. It is important, transition finance is important because these are industries, these are sectors which are called hard to abate industries because of the achieving significant reduction in emission is technically challenging. It requires a lot of funding and it requires major investment in research and development. Many key industries such as shipping, aviation, industries involved in chemicals, cement, may actually need to undertake complex transformation to reduce their carbon emission. It may mean a complete, somewhat a change in business line, the type of product or the type of raw materials they use altogether. So traditional form of green finance would not be a good fit for such transitional phase. Well, one type of financial instrument that we see through transition finance is what is known as the sustainability-linked bonds or the sustainability-linked loans. And these are financial instruments which incorporate environmental targets in the bonds and loans. And if the issuer or borrower meets their environmental target, like for example, to reduce overall carbon emissions in year on year on a step-down basis, then that is their target. But if they do not meet the target, then the issuer and the borrower would have to pay an increased premium or coupon or interest. And in some cases, to avoid the moral hazard problem where bondholders and lenders may seem to benefit from the issuer or borrower not meeting their targets, the bonds or loans are structured such that these interest or premium is actually donated to a charity organization or used for environmental research. In terms of maybe let me talk very briefly about the key challenges, however, on transition finance is really the lack of private sector funding, because there is no clear definition on transition activities. That's one. And secondly, then that leads to fears of greenwashing, which I mentioned before. And the fact that there is just perhaps no clear demonstration of a successful case, and that's kind of difficult for private sector funding to consider the credit risk and what is the long-term benefit of transition finance. So that's a little bit of the key challenge as well on transition finance.
And could you briefly explain to me perhaps how blended finance then forms part of the picture to achieving net zero goals?
So this nicely ties in with the earlier question as well. We talk about transition finance and the difficulty for private sector to provide all the funding. Now, in the transition finance, I also mentioned that there is, the reason why transition finance is difficult or challenging is that not all projects may be bankable and there's a lack of success cases. And there are also risks in such financing because these financing could be done in underdeveloped or developing economies where there's currency risk, there could be political risk, and overall a problem or an issue or difficulty with assessing the credit risk of that project. So blended finances is where it comes in. It's one of those several tools to mitigate a risk, and that is by combining concessional financing and with commercial financing. So that really means with government sponsor or public funding, or for example, IFC, International Finance Corporation, they carry out blended finance operation in partnership with donors. And concessional financing is supported by donors combined with what IFC has, and of course, commercial financiers are regular kind of investment and financing. And so what we do see now, there being a push is for blended finance to also involve philanthropies and foundations. And because these philanthropies and foundations, they have a different risk absorption capacity, and where traditional financial returns may be low, but societal social returns may be high. So ultimately, blended finance is important in getting to for industries, especially transitional industries, getting from brown to green, where blended finance looks at getting out as much capital as possible to bridge gaps, funding gaps, so that all of these carbon heavy industries can make that transformational change.
Brilliant, thank you. Well, that concludes our conversation for today. It's been so interesting. So thanks so much again for joining me.
Thank you very much, Olivia. Thank you for having me as well.